I'd like to welcome you all to what I think is the 7th autumn conference. Maybe someone else has a different figure. To be held here under the auspices of the Quaker Council for European Affairs. QCEA is once again grateful to Quaker Peace and Social Witness from Britain Yearly Meeting for agreeing to co-organise this conference, as it has done on the last few occasions. This is actually the second time that we've devoted a conference to economic justice. If you read QCEA's periodical publication around Europe, you'll be aware that it has become customary. Sorry, can you hear me? I'm not using the microphone. Can everyone hear? Okay. I prefer not to use it if I don't have to. We avoid the clicks and buzzes. If you read around Europe, it's become customary in recent editions to look back over the archives and see how subjects that were discussed in earlier numbers have evolved since then. The result of this backward glance has been to remind us that things don't change very much or very quickly. Or, as we're in Brussels, I could say perhaps, plus ça change, plus c'est la même chose. I think you'll agree with me, and your presence here demonstrates it, that it's very timely to revisit economic justice. Europe, in common with other parts of the world, has been experiencing enormous economic and financial upheaval over the last few years. And while much attention has been focused by the media on bankers and other inhabitants of the world of high finance, a very small number of whom have been obliged to sacrifice a part of what many of us, I think, would consider to be the excessive rewards that they have come to expect as their right, the real impact of this crisis has been felt by those who live in less comfortable circumstances. In an already unequal world, the poor, the underprivileged, the elderly, the sick, the unemployed have found their situation worsening, not only in relative terms, but sometimes even in absolute terms. Many people have been hit twice. Once by losing their work or by having to accept a freeze or even a cut in their income, and then a second time by having to endure reductions in the level of welfare benefits and public services that might have been expected to alleviate the effects of their reduced incomes. Economic injustice has many dimensions. At world level, we know that there is huge inequality with real suffering in many regions, especially in the southern part of our shared planet. And our national and international institutions, national governments, and of course the European institutions, have so far seemed incapable of making a major impact on this situation. In Europe, and in each of the countries that compose it, there are also enormous inequalities that many of us consider scandalous. As Quakers, we are obliged by our testimonies to consider how we can work to reduce these inequalities and to ensure that every human being is treated with respect and dignity, whether we do it by political and social activity or possibly in our individual lives. And I hope that this conference will help us all to see better how we may contribute to this task. And to begin this weekend of discussions of economic justice, I'd like to introduce Trevor Evans, who is a professor of economics in Berlin, and he will make the opening address of this conference. If he wants to tell you anything about himself, apart from the little I've said, he can do so. Thank you, Trevor.
Thanks very much. Can you hear me at the back? Yeah? I prefer to talk without a microphone, but I am losing my voice, so kind of wave if it kind of gets inaudible. Thanks very much for the invitation. I'm perfectly happy to be interrupted while I'm talking. I've been asked to talk for about 55 minutes and leave half an hour for questions, but do feel free to interrupt at any stage. It's a kind of nice small meeting here. So I've been asked to talk about the crisis, so I'm going to talk a bit about the background to the crisis and then its impact, and then at the end I'll outline some of the alternative proposals that have been put forward by a network of economists in Europe, which I coordinate, called the European Economists for an Alternative Economic Policy in Europe. And we publish a report once a year, and the 2014 one will be coming out in 2 or 3 weeks. Okay, so the causes and consequences of the crisis. First of all, a few background words. Looking around here, I will see that many of you, like me, grew up in the 1950s and 1960s, a time when Western capitalism enjoyed probably its most successful ever phase. And we had full employment for men, and more women were being drawn into waged work. There was a rising standard of living in all the Western countries, and an expansion of welfare services. And that came to an end in the mid-1970s. And there was a strong period of malaise in all the European countries, in North America. And in the early 1980s, we had the beginning of a new phase of capitalism that was very, very different from the form of capitalism that we'd had in the initial post-war years. There are many features in which it was new, but I think the one that is probably most relevant for the discussion here is that it involved a major expansion of the financial sector. After the big crisis in 1929, the financial sector had been subject to very, very strict controls in the United States, in Britain, in France, and in every other country. That since the 1980s, we have seen this enormous growth of the financial sector. Banks have become bigger and bigger. We've had a huge growth in the role of financial markets, and there has been the growth of extremely complex financial instruments that are traded on the markets, in many cases deliberately put together so that they can't be understood. The key security that was at the center of the crisis when it broke in 2007, something called collateral debt obligations, were designed so that they couldn't be understood. And this process began in the United States and in Britain in the early 1980s under President Reagan and Mrs. Thatcher. And it followed, not quite as harshly, but some years after in Germany, France, and the other European countries. And one of the important things to note for us is that as part of this, big European banks began to become very active in the United States. So that banks like Deutsche Bank from Germany, UBS, Paribas, the big British banks were all very active. Just to give you some idea of the scale, this is just showing all the different sorts of financial instruments, bank deposits, bonds, shares, and so on. The figures here to note are firstly this one here, 10. This is the GDP. This is a measure of the output of all the economies in the world in 1980. It was about $10 trillion. And the value of all the financial securities was about 12 trillion. So they were roughly equal. And they'd been roughly equal throughout the 50s and 60s and 70s. Oops. Sorry. Yeah. By 1990, gross domestic product, the total output was at about 22 trillion. Financial securities at 43 trillion, twice as big as output. By 2000, output was up to 32 trillion, financial securities 94 trillion, 3 times as big as the output. And by 2007, when the crisis broke, world GDP output was up to 55 trillion, and financial securities were nearly 200 billion, 4 times as big as output. So what we see there is that from financial securities having been roughly the same size as total output, by 2007 you had this massive superstructure of bank deposits and financial securities that in some way were sucking resources out of the real economy.
Sorry, what's the financial security?
That shares in companies, the bonds that are issued by governments when they borrow money, the bonds that are issued by companies when they borrow money, and the deposits at banks. So it's a rough measure of the different forms of financial assets. Now, the crisis originated in the United States. That from the 1980s onwards, real incomes for 80% of the population did not rise. They remained constant. That all the growth in the United States went to the benefit of the top 20%. Within that, the top 1% got most of the benefits, and within that, the top 0.1% got the largest share. So this is a phenomenal change from the initial post-war years when the benefits of growth were shared out between different sectors of society. Now this presents a problem for the economy. If the very, very top people are getting nearly all the new income, who's going to buy the goods? And the answer that the United States came up with was you lend the working class and the middle class money so that they can buy the goods. And the result of that is that from the 1980s onwards, growth in the United States was very dependent on lending money to working class and middle class households. And there are various ways in which that occurred, but from the late 90s or 2000 or so, one of the key ways was through a boom in mortgage lending. And many of you have probably heard of so-called subprime mortgages. Subprime mortgages were mortgages that were given to working class and low income groups who, because they didn't have a regular secure job, or because they couldn't put up a 20% deposit for their house, were not eligible for a normal mortgage. And there was a big growth in these mortgages. They were very profitable for the banks because they could charge much higher interest rates. And so long as house prices were rising, poor people were buying a house using these mortgages with high interest rates, but they were able to refinance, and when they refinanced, they could use part of the money to pay for consumption spending. This was a model that was completely unsustainable. And a few economists did write before 2007, this is not going to last. And the crisis actually broke in August 2007. Or, if you want to know, on the 9th of August 2007, when suddenly the banks in the United States and in Europe realized that many of the other banks they were dealing with had been lending money to people that were never going to be able to pay it back. And on that day, the banks stopped lending money to each other. And from then on, the crisis just got steeper and deeper and deeper, and it became most dramatic in September of 2008, when the two biggest mortgage institutions in the United States went bankrupt, when Lehman Brothers, one of the big 6 New York investment banks, went bankrupt, and where in the following week, a whole series of major financial institutions in the United States, including the biggest insurance company in the world and 2 other massive banks, all went bankrupt. And the result of that was as if somebody had jammed the brakes on the US economy. That in September and October of 2008, the big banks in the United States stopped lending, even to their very best known big multinational customers. And the result was a sharp downturn in output in the United States. Many workers lost their job. And this also had a major impact on the euro. And let me now turn to Europe. Let me begin with just a picture of what's happened. This is showing the change in the output of the European economy over 4 quarters, i.e. compared with the year before. And you can see that growth, it had been quite low at the beginning of the 2000s, there'd been a recession. Growth began to rise up to 2007. One curve is showing the European Union, one is showing the euro area. There's not much difference between them. That once the financial crisis began in August, September 2007, growth began to fall. And then with the collapse of Lehman Brothers and the complete credit freeze in the US, we had this massive downturn in output. In the last quarter of 2008 and the first quarter of 2009. The biggest fall in output since the crisis in 1929-1930. Here in Europe, output continued to fall. Everything below zero means that output is falling, but it wasn't falling quite as rapidly. And then we began in 2010 to have some growth again in Europe, but then the crisis in the euro area kicked in. And once again, we had a further recession. And I want to now turn to try and explain that to you. The crisis in the United States was transmitted to Europe through 2 main channels. The first was that because the very biggest European banks had been lending so much money in the US, when the financial crisis broke in the US, the biggest European banks were hit. So they stopped lending in the US, but they also stopped lending in Europe. So here in Europe too, even the best known companies had difficulty getting credit from the banks at the end of 2008 and in 2009. The second important way in which the crisis was transmitted to us in Europe was through trade. That because of the downturn in the United States, there was a major collapse in the demand for goods that are produced in Europe and sold in other parts of the world. And Europe's exports fell by something like 30% in 2009. And under the impact of these 2 channels, as I've just shown you, there was this very, very sharp downturn in output in Europe at the end of 2008 and the beginning of 2009. Because of the crisis, the European governments all intervened in different ways to try and alleviate the impact of the crisis. The first thing they did was to intervene to rescue the banks. Now, many of you will wonder why these large, profit-driven organizations that had been doing very, very well should be rescued. And the answer is because governments were concerned that if these big bankrupts went bankrupt, which was on the cards, they would have set off a chain reaction of bank failures and led to the sort of cataclysmic crisis that we saw in 1929-1930. And many of the biggest banks in Europe had to be rescued by the state, and the state became major shareholders in Germany, in France, in Britain, and so on.
Did that not happen in the USA?
It did as well. Oh yes, absolutely. The second important effect for the government was that when output started to collapse in 2009, all the West European and Central European governments began to increase their spending to try and counter the impact of the downturn. That too cost money. In general, they intervened around 2% of the economy's total output, but that's still quite a lot of money. And thirdly, because of the downturn in the economy, businesses were making no profits, so they paid no taxes. And as workers lost their jobs, so the government lost tax revenue. So there was a very sharp fall in tax revenue. And if we put these three things together, rescuing the banks, intervening in the economy to try and counter the downturn, and the large fall in tax revenue, we see a very big increase in government deficits. They were spending huge amounts of money. But what I want to emphasize is that these deficits in government spending, these fiscal deficits, did not cause the crisis. They were the result of the crisis. They were the result of rescuing the banks, countering the recession, and the low tax take. And just to show you, this is looking at the deficits of European governments as a percentage of economic output in 2007, the last full year before the crisis really bit. You'll see that all countries had deficits under 3% except Greece, and that a number of countries, including Spain, had surpluses on their government budgets.
It's difficult to see the slides. Could we have the house lights down a little? And if you could explain the numbers, because we can't see the numbers or...
Sure.
Thank you.
This first line here is 5%. So this means that this is the line at which governments would be borrowing money equal to 5% of their economy's output. And as you can see, every country except Greece had deficits well below 5%. And Spain here, can you see the arrow? Spain here is below the line. That means that it actually had a surplus on its government budget. The government was taking more in taxes than it spent before the crisis. With the outbreak of the crisis, then governments had to spend money to rescue their economies, and the red line shows you the deficit in 2009. And you can see now that nearly everywhere had deficits of over 5% of output, and a number of countries had deficits that were over 10% of output, including Ireland, Greece, Spain, and Portugal.
How does the UK fit into that?
The UK was about 10%. The UK had a very large deficit. So it wasn't quite at the same level as Greece, but it was up there close to Spain. And in the following year, Ireland went up to over 30%. I mean, Ireland had had an absolutely catastrophic policy of allowing banks to do whatever they liked. And they very stupidly, in my view, agreed to rescue all the banks, and it's not clear that that was necessary. Whereas from 2010, other countries began to reduce their deficits. But what I'm trying to show you here is that in 2007, most countries had very, very small government deficits or no deficit. The deficit happened as a result of responding to the crisis.
And that increased deficit is corporate welfare rather than increasing the welfare budget for people who receive unemployment benefits and so on.
Yeah, I mean, well, firstly...
So it's capitalism rescuing capitalism, is it?
The first was the big sums rescuing the banks were clearly straightforwardly rescuing the banks. That if they had been allowed to go bankrupt, the shareholders would have lost their money. Some of the money was involved in increasing government spending, which would have then involved the government buying goods, which then go to private firms, so that would have benefited the firms, but also would have helped them to keep workers in their jobs. Now, the crisis was at least as severe in the United States and Great Britain. But they didn't have a debt crisis. It was only in the euro area that a debt crisis developed. And the question is then, why did Europe or the euro area have a debt crisis and not the US or Britain, which had much bigger deficits than most euro area countries? And the answer is that it is to do with the architecture of the way that the euro area was set up. The euro was introduced as the joint currency in 1999. But with that, Europe got a common money, and with that, a common monetary policy, an interest rate set by the European Central Bank for all the euro area countries. But there was no common fiscal policy. Decisions about government spending continued to be made by national governments. There was no common wage policy. Wages continued to be national policy. And there was certainly no industrial policy. So we were faced with a very, very undesirable situation that many economists pointed out at the time. A common monetary policy, but no common government policy to counter the ups and downs that you find in a capitalist economy. And this began to show itself through the divergent growth of wages and labour productivity in the euro area. Labour productivity refers to how much output a worker produces per day or per week. And in the post-war years, one of the reasons that Europe had developed very successfully was that wages went up roughly in line with productivity, a very sustainable situation. But particularly after the introduction of the euro, we started getting a very sharp polarization between the member states. And this polarization was most marked between Germany and the states of southern Europe. After the introduction of the euro, Germany had very slow growth. And unlike any other European country, there was no rise in real wages between 1999 and 2007. I can tell you that. My wage check didn't change the whole time. Now, the economy was growing slightly, not much, but slightly, but real wages weren't going up. So who was buying the increased output? The answer is that Germany sold it to other euro area countries, particularly the countries of southern Europe. And they bought the goods which German workers couldn't buy because their wages were not going up. In fact, as I mentioned at the dinner table, in this time, Germany created a quite significant low-paid sector, perhaps 20–22% of the workforce, something it had never had before that, after the Second World War. In southern Europe, we had a very different situation. That joining the euro, they got much lower interest rates, that economic growth was very strong, they began catching up with the richer countries in northern Europe, but because their economies were growing very strongly, they were sucking more imports in, and that meant they had a trade deficit. Now you might wonder, how can countries have a trade deficit for year after year? It means that you're importing more goods than you export. And the answer was that banks from Germany and France lent them the money. So German banks were lending money to Greece and Italy and Spain and Portugal to buy German exports. The goods that German workers didn't have the money to buy because their wages weren't going up. This couldn't last. This is not a sustainable economic model. And the crisis broke in the country that was weakest, namely Greece. It became clear at the end of 2009 that it had this deficit. The previous government had not published the correct figures that showed the size of the deficit. And as soon as the figures were published, banks started speculating against Greek government bonds. They sold the bonds. That meant it became much more difficult for Greece to finance its government deficit. And in May of 2010, Greece became the first country to be rescued by the European Union. And over the next year, the crisis spread to Portugal, to Ireland, to Spain, and to Italy. And here we have a graph, and for those, this starts in 1999. Can you see this at the back?
We can see the lines, and it's helpful when you tell us the years.
So this begins in 1999. The blue line is showing the German current account balance. This is roughly their trade balance. And you can see that the euro was very good for Germany, that its trade balance went up and up and up and up. So that in 2007, just before the crisis really bit, it had a surplus of almost 200 billion. Without the euro, this would not have happened. If Germany hadn't had, yeah,
Was that also partly influenced by the fact that the euro at that time was very, very weak, certainly compared to, say, the American dollar and the British pound? Because I can remember when the euro was worth about 65 pence, when previously, when the euro almost started, when it was ecu, it was about 85 pence to the euro, to an ecu. So you can see that it's something that over time, the value of the euro went significantly lower, so it helped German exports.
the euro weakened in 1999 and 2000 and 2001. But from 2002, the euro began to gain quite strongly, both against the US dollar and the British pound. But you've hit on a really important point. The reason, one of the key reasons why Germany was able to build this very large trade surplus, because now it was locked into the same money as its main trading partners. If Germany had had this big surplus before the euro was introduced, the Deutschmark would have gone up and up and up in value. And German exports would have become more and more expensive for the other European countries and for other parts of the world. But because Germany was now locked into the same money as that of the other euro area countries, it had an enormous advantage. And it could build up this enormous surplus, which it did through from 99 up to 2007. The red line shows the trade balance of Greece, Italy, Spain, and Portugal. You can see in 1999, their trade was almost balanced. It was around zero. But there we have exactly the opposite story, that their deficit got bigger and bigger and bigger. So that by 2007, they had a trade deficit of around 200 billion euro, whereas Germany had a trade surplus of around 200 billion euro. And this development, neither of these would have been possible without the euro. Let me now turn to how the EU responded to this crisis. That when Greece and then the other countries began to find that they couldn't finance their government debts, they turned to the EU, and the loans that they were given by a combination of three institutions: the European Commission, which set up a special fund, the European Central Bank, and the International Monetary Fund. But it's the first of these, the special funds set up by the European Commission, that were most important. But because there were three of them, and they all took part in the negotiations for granting a loan, it became known as the Troika. And they provided loans to these countries, but in each case, they imposed incredibly strict conditions. And above all, they focused on government deficits, fiscal discipline. Now, I showed you before that the government deficits did not cause the crisis, they were the result of the crisis. But what the Troika did was to focus on the country's deficits and to insist that governments cut their spending in order to eliminate their deficits. And there have been a large number of measures all rushed through very, very quickly. One of them is a complicated set of 6 measures imposing very strict rules on governments, and this has become known as the six-pack. And in theory it applies to all countries in the euro area, but in practice it has been implemented almost exclusively on the countries facing a deficit. And then last year they did something that to my mind is absolute lunacy, that at German insistence countries introduce constitutional changes saying that in future they must run budgets that are balanced. And this is known popularly as the debt brake. The result of these conditions was that all the countries that were hit by a debt crisis were forced to cut their spending, to cut wages in the public sector, cut the spending on unemployment benefit, on social programs, on healthcare, and so on. And the result has been that all the countries hit by these measures have had a very sharp downturn in their output, a very big increase in unemployment, and a major increase in poverty as people lose their jobs and welfare benefits are cut. Initially it hit the countries that had had to turn for the EU for support. But ultimately, the southern European countries were also the market for exports from France and Germany and the northern countries. So the result was that having imposed incredibly strict austerity on southern Europe, that then dragged the whole of the euro area, including the rich northern euro area countries, into a recession. Now, I've already indicated that this was socially extraordinarily regressive. You touched on this in your introductory remarks. But there's an additional economic problem. When your economy turns down, your tax income falls, and it's even more difficult for countries to service their debts. So the result is that as the recessions bit, the countries that were under these debt programs, these austerity programs, found themselves getting even more difficulty because they couldn't meet their debt payments. And this then led to a banking crisis. And the banking crisis is the result of a vicious spiral between the government's debt and banks. That banks all hold government bonds. It's one of the instruments that are very flexible for banks. They can easily use them if they need to sell to raise money. All banks hold government bonds. But the problem is that the bonds of the debt-hit countries of southern Europe were all losing value. So the banks that initially thought their books were balanced found that one of the key assets on their books, government bonds, were losing in value. And that had the risk that more banks were going to fail, and if they failed, they'd have to be rescued by the government. And then we get to the other side of the vicious circle, that because investors thought that governments were going to have to rescue the banks, they started selling government bonds, which exacerbated the problem in the bond market. And a vicious spiral developed, where government bonds were losing their value, so banks had bigger problems. As the banks had bigger problems, it was expected that the government would have to bail them out, so government bond prices fell even more. And this situation became exceedingly critical. And at the end of 2011, the European Central Bank lent the banks 500 billion euro. They lent banks everything they required. They said, how much do you need? And they lent it at 1% interest for 3 years, and there were no conditions.
Where did
a central bank creates money.
Out of nothing.
That's the great thing about a central bank. It creates the money in our economy. That you can think, if you like, of printing banknotes, but actually that's not what happens. What happens is that if a bank wants to borrow 100 million from the central bank just writes 100 million euro in the account of that bank. And because it's the central bank, it can do that. And that bank then has 100 million in its account at the central bank that it didn't have before.
Can I have some of that?
If you found a bank, yes. So we have this extraordinary situation.
Can I just have a point of clarification?
Sure.
You said that the central banks create the money supply, and yet there's an organisation in the UK called Positive Money, which suggests to us that the commercial banks create the annual increase in the money supply as interest-bearing debt in the so-called profitable years. Is Positive Money right about the profitable years? And
I'm not familiar with Positive Money, but that point is absolutely right. That when the central bank gives a loan to a commercial bank, it puts money in their account at the central bank. When a commercial bank gives a loan to a business, or to you if you'd like to buy a new car or something, it writes money to your account that didn't exist before. Yeah.
I think it's helpful at this point to distinguish between M0 and M4. Sorry to introduce a technicality, but M0 is the money that the central bank creates and stays within the central bank. M4 is the money that the commercial banks create and that circulates in the economy.
Yeah. Thank you. So, the European Central Bank, alarmed at what was happening, asked the banks how much they required. They got 500 billion in December 2011 and another 500 billion in February of 2012. And at a time when the European authorities were insisting the European Central Bank cannot lend to governments, it was lending to the commercial banks with no conditions. But this wasn't enough to stop the speculation against government bonds in the euro area. And in the first half of 2012, the situation continued to become more and more critical. And at the end of July 2012, Mario Draghi, the head of the European Central Bank, announced the European Central Bank will do whatever it takes to defend the euro. And for the first time, it began to check the deteriorating financial situation. And in September, Draghi and the European Central Bank clarified what they meant, and they said that if a government in the euro area was subject to speculative pressure, if investors started speculating against that government's bonds, the European Central Bank would intervene on whatever scale necessary to buy those bonds. And again, it's the same. The central bank just creates the money it needs to buy the bonds. And it also made it clear it would only do that if countries reached an agreement on an austerity package. But this program, known as outright monetary transactions, this promise that the European Central Bank would intervene on any scale necessary to buy government bonds, changed the situation. That with that, the financial markets stopped deteriorating. And since the end of 2012, there has been a very, very fragile stability in the financial markets. But the situation is in no way solved. And since then, banks have not increased their lending. Throughout the euro area, banks have not increased their lending. So the crisis has been prevented from deteriorating. But for those businesses that need bank loans to function, the banks are not willing to lend. And one of the reasons for that is they are still sitting on huge amounts of non-performing loans, loans that they should write off. In the United States, the big banks have substantially written off the bad loans. In Europe, the banks have scarcely begun.
How do they write them off?
That they have to take a loss against their own capital. That what they sometimes do is set up a separate either institution or branch within their institution to which they transfer the non-performing loans, as they're called, the ones that will not be paid back. But ultimately, they have to take a loss from their own capital. And that, of course, is why they don't want to declare them. Yeah?
I don't know much about the finances, but it seems to me that speculation is at the heart of the breakdown. Can that not be stopped in some way or another?
There were real imbalances that were a problem that needed to be dealt with. But the reason it came to a crisis situation was precisely because of speculation. And I'm going to say something about that in the last part of my talk. Yeah?
Are there no limits to the amount of money that the central bank can create then?
There are no finite limits, no.
So why not do it then?
Well, absolutely. And of course, this is
There are consequences then.
This is what the British Central Bank and the US Central Bank are doing since the crisis began. And one of the reasons why the crisis developed to a debt crisis in Europe was because the European Central Bank is bound by absurd rules, including the rule that they're not allowed to lend directly to governments. In the United States and Great Britain, that doesn't apply, and that's why they didn't face this sort of debt crisis, but why the euro area has. The euro area authorities have shot themselves in the foot.
But surely that was what some European countries were doing anyway. They were just printing money.
I can't see who was that. Yeah.
Surely Italy, Greece, Spain, were just printing euros without anything behind it.
No, they weren't. They were, because the thing is that the euros at the central bank level were controlled by the European Central Bank. What Greece and Italy and Spain were doing is that they were buying more goods from abroad than they were selling. And they were able to do that because German banks and French banks were lending the money. So it wasn't that the Greek or the Italian or the Spanish government was printing money, it was that the banks from Northern Europe were lending the money to buy goods from Northern Europe.
Because Greece and such like haven't got their own central banks anymore.
Exactly. Exactly.
Can I just, as a point of precision, is it not true that the UK are also, even though we're not part of the euro, is still under the Maastricht Treaty regulation that money can't be lent straight to government, it has to go to the financial markets, which is what has happened with our QE policy and why it's ineffective. That, in my understanding, also applies to the UK, because we are a member of the EU,
Yep.
even though we're not a member of the euro.
Well, firstly, I mean, as I mentioned in answer to an earlier question, the US did have, Britain did have this very, very big deficit. And they are not bound in the same way by the very, very rigid rules of the euro area, which meant that the Bank of England was able to respond from the beginning much, much more flexibly than the euro area central bank was. And it's worth mentioning that although the ECB can create money there's no legal limit on how much money it can create, at every crucial stage, the German members of the European Central Bank Council, together with those of the Netherlands and Finland, have voted against many of these measures. So it is a political decision by them on to what extent the central bank should expand the supply of central bank money.
I missed one word. They voted against.
That at different stages, when the ECB has acted very decisively, that the German representatives, together with those of the Netherlands and Finland, have opposed it. So that this idea of lending unlimited amounts of money, and particularly what I have just mentioned, this program of the central bank, the European Central Bank, committing itself to buy unlimited quantities of bonds if necessary, was not supported by the German members. Yeah?
How influential is the fact that much of the German banking system, apart from say Deutsche Bank and Commerzbank, is largely either state-owned by either the states of Germany or done by cooperative institutions such as the Sparkassen, In France, for example, Credit Union before it was taken over by Credit Agricole was partly state-owned, as was BNP. How influential was that in the economic policy?
I don't think it was that. That was not the decisive factor that determined the position of the representatives of Germany on the European Central Bank. They were opposed to this expansive policy in response to the crisis. But you have pointed out something that is very interesting and very, very important, that Germany is the only major advanced capitalist country where more than half the banking sector is non-profit making. So it has this very large sector of locally owned savings banks that are owned by the local and regional states. And it has a cooperative sector that's also about 20% of the banking sector. So that the capitalist banking sector accounts for about 35% of assets. Very unusual. And then within that, of course, that is dominated by one bank, which is massively bigger than any other.
But those not-for-profit banks, still operate on an interest charging and distribution policy, don't they?
The local savings banks do charge interest, but they lend to small and medium enterprises, and whereas lending throughout the euro area tended to collapse after the onset of the crisis, the small savings banks, locally publicly owned savings banks in Germany, were one of the very few sectors that continued to lend throughout the crisis. They weren't hit seriously by the crisis, and they continued to lend after the crisis broke out. But sure, they charge interest, yeah.
Should we let you continue with your speech? Otherwise you'll never finish.
Okay. Could I have some more water, please? In view of time, this is basically just showing the interest rates as the crisis. Oh, there was some behind me. Sorry, I didn't see that.
You're not looking behind you, are you?
I didn't mean to. Thank you very much. So this is an indicator. This is showing the interest rate on 10-year government bonds. You can see that 2000, 2008, they were all pretty together and packed. As tensions emerge, they begin to diverge. The Greek one goes up and up and up and up, reaching almost 30%. Ireland gets up to about 14%. Here we've got Portugal up to just under 15%. All of them going up as the crisis develops, but as then they begin to reach deals, it begins to fall. And particularly, we can see that in 2012, once Draghi had announced that the European Central Bank would intervene to defend all member states' government bonds, you get all the interest rates beginning to fall. Germany and France have benefited massively because the money that was in Greece or Portugal or Ireland or Spain or Italy was all put into Germany. So Germany and France down here have done very well with unusually low interest rates thanks to the crisis. Okay, that's a bit of the explanation. I'm now just quickly going to talk about some of the impact. How am I doing for time?
It's just gone through.
Keep going.
Okay, then I've just got some pictures here. I've divided up countries in Europe into different groups. So up here we've got what I call the Euro area core countries. So Germany, France, some of the smaller countries. And this, you can see here, this is the expected growth for 2013. It's an estimate, so it won't be exactly right. But it shows that most of the countries in the Euro core are expected to grow this year. France on the balance, and the Netherlands falling a bit. The Euro area periphery, Ireland will grow a bit, but the others are expected all to decline yet again. The new Euro area countries, Estonia, Malta, Slovakia, Slovenia, Cyprus, all of them small countries, are a bit mixed. some of them growing, some not. And in the northern non-Euro, Sweden, Denmark, and the United Kingdom, some growth is expected this year, and in most of Eastern Europe, some growth is expected this year. It looks here as if slowly the recession is coming to an end. But now look, if that does work out, how the situation in 2013 compares with when the crisis began in 2007, 2008. The group in Northern Europe now nearly all have output that was larger, slightly larger than before the crisis. The Euro area periphery, Southern Europe, all have output that's way below where it was in 2007, 2008. Way, way below. Here's the zero line. With Greece at 24% down on its output in 2007. The new Euro area countries are split. The northern non-Euro area countries, only Sweden has output that's higher than before the crisis. The United Kingdom still has output below the crisis level, and Denmark too. And virtually all of Eastern Europe has output that's significantly below where it was before the crisis. So although growth is expected in quite a lot of countries this year, in nearly all of them, except the small group of Northern Euro countries, output is still below where it was before the crisis. I prepared a handout with the figures on this and copied 100 of them and left them in my hotel room. I don't know if anyone's staying at my hotel. I think because of my health, I'm not going to be here tomorrow. But if there's anyone at the same hotel, I'd be very happy to.
Which hotel?
Euroflats.
Where is it?
By, you got it, you're right. By Schumann, by the European Commission buildings.
It should be possible for the people
If there's anyone here, yeah.
the people coming from Quaker House tomorrow morning might be able to call in and pick it up. Is it
If there's
Boulevard
anybody
Charlemagne?
afterwards, we can.
Is it Boulevard Charlemagne?
Yeah,
Yeah.
yeah.
Should be possible for the people coming from Quaker House.
Presumably, will we share electronically anyway, these resources, will they?
Sure, I can make my slides and the sheet that I prepared, yeah. The figures on the sheet are slightly more up to date than these ones. So here we have unemployment, the same groups of countries, the Euro area core between 5 and 10%, the Southern Europe, the periphery, between 10 and 26%, the new Euro area countries around 10%, Northern Europe, including Britain, is 7 or 8%, and Eastern Europe around between 7 and 12%. It's a dismal picture. There's nowhere that's good. And even for countries like Germany, where it appears to be good, there's a lot of people in very low-paid jobs or on part-time jobs who would like a full-time job. It's a dismal picture, and it is appalling in many of the southern European countries. If we look at youth unemployment, the situation is even more catastrophic. And even in the rich northern countries, you've got somewhere like France here with 25% youth unemployment, and in the southern Euro area countries, rates go from 27. Ireland joins southern Europe for these pictures. And Spain and Greece here are at 55, 58%.
What's the age for you?
This is 16 to 25. The new Euro area countries, also appalling levels of youth unemployment, the lowest 12% in Malta, up to 34% in Cyprus and Slovakia. Denmark 12%, Britain 20%, Sweden, Social Democratic Sweden 34%. And in the Eastern European bloc, all of them at 20, up to 25 or 27. So an appalling problem of youth unemployment, and Croatia 52%. So a very serious unemployment position, and youth unemployment catastrophically high. And here's the last of my slides on the impact. This is looking at what's happened to real wages between their peak. The peak in real wages was, depending on the country, 2009 or 2010. And if we look at how real wages this year, that is inflation-adjusted wages, compare with their highest level before the crisis broke, we can see that in a small group of Northern European countries, real wages are now a bit higher than before the crisis, with Germany at the top. Note that Germany had no rise in real wages from 1999 to 2007. So some wages going up in the export sector represents a change there. In the euro area periphery, real wages for those that have got a job, remember unemployment is very high everywhere, are well down everywhere, with in Greece real wages down 22%. So we have, on the one hand, incredibly high unemployment, and those that do have a job have a real wage that has fallen by almost a quarter. In the new euro area countries, wages have fallen everywhere. In the northern non-euro area countries, only Sweden has seen an increase in real wages since before the crisis. In Britain, real wages down about 3% compared with before the crisis. And in the Eastern European countries, a few countries, Bulgaria, which began with very, very low levels of income, and slightly in the Czech Republic and Croatia, small increases, but in most of Europe there have been very, very serious falls in real wages between about 10 and 15%. So it looks as if the recession is coming to an end. But in most countries, unemployment is very high, and projections of all the international institutions, the European Commission, the International Monetary Fund, the Organization for Economic Cooperation and Development, all of them indicate growth will be very low, and they do not expect unemployment to fall to any significant extent in the next few years. So a very, very serious position. The last part of my talk is summarizing some of the alternatives that has been put forward by the network of economists that I work with. And I'll go through them quickly, and if you have detailed questions, I can come back. The first of our demands is to downsize the financial sector. The crisis began in the financial sector, and we argued that there should be a complete separation between commercial banks, that's banks that have deposits and give loans, and investment banks. Investment banks are the ones that involve the highly speculative activities in buying and selling bonds and other financial instruments. So we say they should be completely separated. And there should be strong limits on the size of banks so that no bank is too big to fail. And we also strongly support the promotion of publicly owned saving banks and cooperative banks. Secondly, we say that the speculative institutions, the investment banks, the hedge funds, the private equity funds, should not be allowed to operate with borrowed money. At the moment, hedge funds, private equity firms, investment banks, they in general borrow 30 euro for every 1 euro of their own money. If
Who
you
are they
stop,
borrowing from?
sorry,
Who are they borrowing
from banks, from banks.
The hedge fund borrow.
Yeah, hedge funds have a small amount of money of their own. They borrow up to 30 times as much, and then they involve in these highly speculative activities. We argue they shouldn't be allowed to operate with borrowed money. We also argue that they should be required to publish their investment strategies. And with those two conditions, no borrowed money, and publish their investment strategies, they're effectively finished.
What is a hedge fund?
A hedge fund is a highly speculative fund. Normally, you have to have at least $1 million or €1 million to put money into a hedge fund. And because it's considered that it's the money of people that can afford to lose it, they're subject to very, very little regulation, which means they can buy and sell anything they like, And in general, they tend to buy shares in a company, or they buy raw materials, or they buy finished foods, anything that they think the price will go up in the short term, and then they sell them again quickly.
Of course, they also operate by selling things they don't yet own.
Yeah.
So they make money in a downturn by selling short.
And we argue that financial markets should be strictly regulated. Most of the instruments on financial markets do not benefit non-financial companies or households. They are created by the financial sector in order to make money. They have created a mountain of instability which is very, very difficult to penetrate. And we argue in a series of much more specific proposals, which is available in our report on the internet, that they should be tightly regulated. Secondly, we argue that government budgetary policy, instead of being forced to follow austerity, i.e. balancing their budgets, should be aimed at promoting employment. In a capitalist economy, the economy does not, of itself, come to an equilibrium at full employment. It needs governments to intervene. And at the moment, the policies of the EU are preventing that from happening. We argue that the top priority of government's budgetary policy should be to promote employment, and it should be with jobs as called by the International Labour Organization, decent jobs, i.e. proper contracts with clear hours of work where workers are not on these flexible contracts that many have at the moment. That we should end attacks on social spending, and we should reverse the major reductions in taxation on upper incomes and corporations that has occurred over the last 20 years or so. I live in Germany at the moment, and there is a major problem. Germany, which is the one that has benefited most from the current structure, has cut its public spending because it's cut its taxes, and the roads and infrastructure in Berlin, where I live, are falling apart. There are holes in the roads. There's no money to repair them. And this is in a country which is extraordinarily prosperous.
I just mentioned tax evasion and avoidance as well.
Right. There's a major issue that of corporations setting up tax personalities in countries like Ireland, like the Netherlands, but also the two biggest tax avoidance centres in the world, London and New York. Yeah.
Sorry, I didn't quite get, I still don't quite get, what is a this is a bit embarrassing.
No, don't be embarrassed.
What is a progressive tax?
A progressive tax means that people who are on a higher income should pay a higher tax rate.
And does that not, in some instances, stymie work?
This is the argument of the economists that have been driving this policy. They argue that if companies or rich individuals have to pay more tax, then they won't invest in factories, in shops, and in that way create jobs for other people.
But that's a fact, though.
It's not a fact. The fact is they're not investing. That's the fact.
They leave rather than actually invest. If they're taxed too high, if you tax somebody, nobody likes to pay more than 50% of their income in taxes. That's a bit steep. Because if you do that, then you're not going to invest in it.
And who pays 50% taxes today?
Well, there's a lot paying 50. If you accumulate all your taxes, all your outgoings, you're paying up to 50% of your income.
I think
I'm paying 50% of my income, I know.
Does that include social security contributions?
Everything.
Okay. I pay 50% with my social security contributions and my pension. But I'm also a good earner. There's virtually nowhere, to my knowledge, in Europe that has a tax rate of 50%.
They don't have a
or
tax
an individual
of 50%.
rate. Yeah.
But if you add all your taxes up, you're paying more than 50% of your income in tax.
Perhaps that's something we could come back to in the discussion.
I would just like to make the point that I would be willing to pay more tax.
The third point that I want to bring out of our policies is that we argue that if you are going to have a monetary policy at the European level, which we have with the European Central Bank, it is essential that we also have a fiscal policy at a European level. And we argue that there should be a shift of resources from national governments to the European Union of equal to 5% of European GDP in order to be able to effectively combat downturns in the economy in regions, nations, or the whole of the European Union.
You mean to say that's 5 times what it is now?
Exactly. At the moment it's 1%, and it's been cut at the moment, yeah. And what that means is we do not have a fiscal policy at a European level.
Fiscal policy mean?
Fiscal policy is when the government consciously increases its spending or reduces its taxes in order to put more money into the economy in order to promote more growth, or if the economy is growing very, very strongly, which obviously is not the case today, it cuts its spending or raises taxes to slow the economy down. So since the 1930s, macroeconomists, following ideas first developed by Keynes, argued that a capitalist economy has sharp ups and downs, and it's necessary for a government to increase its spending when the economy turns down, and then when the economy is growing strongly, to increase the amount it takes in through taxes.
So fiscal is government spending policy?
Fiscal is government spending policy.
Thank you.
And we argue that you cannot have a European level monetary policy with a single interest rate and not have a European level fiscal policy that is able to counter some of the polarization that follows. I showed you in one of the pictures that Germany has been sucking money out of the European Union. It has a trade surplus of about 200 billion. Roughly half of that is with the euro area. It's taking money out of the other euro area countries. When you talk to citizens in Germany, they are not aware of this. They are being told that they are being generous, that they are helping fund the countries in southern Europe. But what they don't mention is that Germany, through its trade surplus, is taking money out of the other countries. This is not a viable situation. We need a European level fiscal policy which can ensure that some of these imbalances are counteracted. Just as within Germany there are transfers from the west to the east, or in Britain there are transfers from the south to the north. That in all nation states there's a national level policy that redistributes. It is not viable to have a single currency in Europe and not have a mechanism to do that at the European level.
How are you going to sell that policy to Germany?
With great difficulty. With great difficulty.
What about allowing some of the Euro countries to actually leave the Eurozone, like Greece, so that they can devalue their currency?
Would you repeat the question, please?
The question was, how about allowing some countries, such as Greece, to leave the euro area? Well, firstly, I should point out that there's nobody in Greece, there's no significant political force in Greece calling for that. And it is certainly true that the German government was for a time trying to push Greece out. But over the summer of 2012, they did their sums at the German Finance Ministry, and they realized that if Greece left, it would set off a chain reaction of problems that would ultimately be disastrous for Greece, because leaving the euro, it would firstly involve monetary chaos, but then they would find that they still had debts, but now in euros, whereas they had a much, much weaker new drachma with which they'd never be able to pay their debts off. And the German government also came to realize that the chain reaction that would be set off by one country leaving would, at the end of the day, cost Germany and the northern countries even more than supporting Greece as it is. So at the moment, no serious force, either in Greece or any southern European country or any northern country, is calling for countries to leave. But there was discussion of that in 2011, 2012. On the euro area debt, we argue that first of all, there should be a debt audit to establish which debts are legitimate. The idea of a debt audit is something that was pioneered in Ecuador, where they looked at the country's foreign debts and they looked at who had given them loans and for what purpose. And if they were loans for legitimate development purposes, building infrastructure, developing the economy, developing social programs, they considered those were legitimate. But if they were loans that were clearly linked to Western banks seeking to make a profit on very dubious grounds, they declared them as illegitimate. And we have a very good case in Greece, that just after the debt crisis broke in Greece, the Greek government asked the German government if it could cancel its contract for 2 submarines. And the German government said, no, you have a contract to buy submarines from us. So when the debt crisis was already causing massive problems, the German government was quite unwilling to make any concessions in that area. So we think that our countries that have levels of debt which they will not be able to repay, Greece will never be able to repay debt equal to 160% of its output. Spain, Portugal will also not be able to pay their levels of debt. At some stage, they will have to be written off. It is better to do that now rather than go through years of recession and mass unemployment. And secondly, we argue that the euro area countries should move towards issuing common euro bonds. That the reason that every country had very similar interest rates on the picture I just showed you in 2007, 2008, was because everyone assumed they were common bonds. But when the crisis broke, it became clear that Greek bonds were the responsibility of Greece, Spanish bonds the Spanish responsibility, and so on. And the result was that private investors speculated against Greek bonds. They speculated against Spanish bonds. If there had been common bonds for the whole euro area, it would not have been possible to have speculated. And we argue that if we're going to have a common currency, it is essential that we have common bonds. The current account imbalances, the trade imbalances that I mentioned, we argue that at present, the pressure is all on the deficit countries to adjust. And we argue that the countries with a surplus, which includes Germany, but also includes some other northern countries, they should also be required to expand their economies so that they import more from southern Europe. And to his credit, Barroso has this week announced that the European Union is going to investigate why Germany has such a big surplus, since this clearly is causing a major imbalance in the euro area.
What percentage of Germany's trade surplus is due to trade with the rest of Europe and with the rest of the world, like China?
Yeah, the euro area trade is just under 50%, EU trade is around 60%, and the other 40% is with other parts of the world. On wages and employment, I already mentioned that throughout the 50s and 60s, wages went up roughly in line with output per worker. It was a balanced, more or less situation. One could argue about whether workers should get a bigger share, and I certainly did that. But it was a stable situation. Since the 80s, we have had this big gap opening up. It's particularly serious in Germany. Productivity has continued to go up, and real wages have been flat. But throughout much of Europe, there has been this problem. France is one of the few countries where wages have gone up in line with labour productivity. Some of the southern European countries, wages went up a little more than productivity. But we need to close this gap. We need to close the widening number of jobs that are low paid and in precarious position. And we also argue, as part of a long-term strategy, we need to move towards a shorter normal working week. At present, we have these huge numbers of unemployed people. This will be a concrete contribution to reducing unemployment. But it would also be an important shift in the direction of a different view of society, where people's lives are not dominated by work, and where there is a more realistic position to change the gender division of labour in relation to childcare.
I might be wrong, but is it not the case in the UK and also in the US that although nominal working hours have come down, actual hours have not?
There was a post-war trend where normal hours did fall, but in recent decades, particularly in the United States, working hours have been rising, and I think they have a bit in Britain. And my last point, we need a European investment strategy. That since the early 2000s, corporations in Europe have not been investing all their profits. They distribute part of their profits to the shareholders, but they are not investing the money that remains. Instead, they have been putting it into the financial markets because they thought they could make more money playing the financial markets than they could by investing in real production. There's a little joke, a story in Germany. What Siemens is one of the biggest electrical engineering companies in the world. What Siemens? A big international bank with a small metalworking workshop on the side. That these big multinationals are operating as major financial corporations. They think like centralized banks. And at the moment they are not investing. We need a major investment program, especially in Southern and Eastern Europe, that its aim should be a fundamental social and ecological transformation. There is a huge amount that needs to be done, simply in the area of energy policy and making our energy systems sustainable. There is a massive need for investment. This is needed, it is desirable, it is possible. Furthermore, Europe actually has an institution that can finance such things. The European Investment Bank is already empowered to issue bonds denominated in euros to finance investment. Its program is quite big. At the moment, it is required to obtain parallel funding from national governments. And of course, the countries of Southern Europe that most need these investment programs cannot raise any money. They're under very strict conditions from the European Commission to cut their spending. But there is an institution that could contribute to that. And we believe that these policies, they're very ambitious. They are clearly a very different set of policies from those that have been advocated by the European Commission and by most member states. But as a network of economists, we believe that these are feasible policies, and we believe that with these sorts of policies, we could begin to change Europe into a very different direction.
Friends, we don't have very much time left. I think a lot of the questions have been asked already as we went along, but obviously there should be a little time now for a discussion, and I saw Michele on his feet.
So thank you very much. I think you put a lot of material in a very short time. I have a couple of questions, but I will focus on what I think is the most important one, which is the policies. They make, of course, a lot of sense, but I'm really wondering on the political economy side of things, also because I'm not quite sure I share your view that these are policies that go counter what the European Commission is proposing. Now, on banking union, on banking reform, the Commission has already put forward a proposal for a financial transaction tax, which is what we call the Tobin tax. We had a 2012 regulation on short selling to stop speculation, and the Commission has also put forward a proposal to cap bankers' bonus. So really very much what we could all subscribe to in this room. There is no way the UK government is allowing this reform. The UK government has a single-minded focus on that point and on protecting the interests of the City of London. On the budget, the Commission is of course would be very happy to increase the budget, but as you was reminded, this amounts to a five-fold increase. On the Eurobonds, again, there is a Commission proposal, a green paper to have some fiscal solidarity is not making any progress. So I would like to have a bigger view, and on investment, although there is this strong focus on public deficits, the Commission is also recommending to kind of protect investment in infrastructure. So how do you see, the sort of political economy side of your proposal, considering that a lot of these are already on the table and are blocked by countries in the front line, the UK?
Can I say that my friend doesn't speak my mind? Your proposal for a reintroduction of Keynesian-style social democracy in Europe is not what Keynes himself envisaged. His view was that governments borrowing money, private money, and paying interest on it during peacetime, which is the essence of deficit-funded economics, was only sustainable for 100 years. He wrote that in the 1930s in Essays in Persuasion, an essay to his grandchildren. I am utterly convinced, to use a Quaker word, that whatever you do to manage capitalism or to not manage capitalism is inconsistent with all of our testimonies and utterly inconsistent with the teachings of Jesus. We in Europe have seen 100 years of blood based upon a Marxist approach to not capitalism, whereas before Marx there was a true socialism based upon the cooperative values and principles, and I'm quite certain, and I have written an essay to that effect, that we can form a Europe which is based upon the cooperative values of equality and equity, and not go for any of this nonsense of trying to manage something, capitalism, which cannot be managed.
The environmental crisis is upon us. Kevin Anderson, professor of the deputy director of the Tyndall Centre for Climate Change Research, is saying to have an outside chance of holding world temperatures within some sort of bounds, we need to be talking about 10% cut in carbon dioxide emissions, another in year by year. Would you like to comment on that?
Yes, we can't have many more questions. There are two over there, and I think we'd have to stop then, so that Trevor has a chance to...
Friend here wishing to speak. We haven't heard from women so far.
All right. Okay, you've convinced me.
Thank you. Very simple question. I just wondered, regardless of whether your ideas would be workable or not, realistically, what kind of influence does your group have on decision makers?
Yes.
Taking some of the earlier points a bit further, all your proposals are geared towards further growth in GDP. And we all know that growth in GDP is closely linked to use of emission of carbon dioxide and use of non-renewable resources. With Europe as a whole already exceeding its ecological footprint, in other words, taking more than its fair share of the world's resources, what you were proposing within the existing paradigm sounds sensible, but the existing paradigm is broken, and so actually we need to change the paradigm.
Can we make that right? One more question, and then I think Trevor has to give some answers.
I would just like to say that was, for me, very, very inspiring and the most clear exposition on the subject I've ever encountered. Thank you. And I think you've answered what I was going to actually ask. Is that where we can find out more?
Yeah.
You're a member. Thank you.
Okay, Trevor, do you want to comment on some of the points that have been made?
It would take almost as long as I took for my first talk. It's clear there are proposals from the Commission to deal with some of the issues that I mentioned. There are proposals to create a banking union. The first step has been agreed that the ECB, European Central Bank, should become responsible for supervising banks at a European area. At the moment we have banks that roam around Europe but which are supervised by national authorities. That is not a viable situation. The problem is that the negotiations are currently stuck because the ECB is, on one occasion, and I agree with them, arguing that to be responsible for supervising banks but not having the responsibility for winding up banks that are failing is an untenable situation. And there's big divisions. I was at a conference last Friday where the German representatives of the German and the French finance ministries, amongst others, were in very polite language disagreeing about it, but there are major differences there. But there is a move towards a banking union. I think more generally, however, Europe, like Britain and like the United States, all set up commissions to inquire why there had been such a major financial problem. And in the case of all of them, they have recommended introducing within banks a separation between commercial and investment banking. But within banks, they call it ring fencing. And to my mind, this is just not going to solve the problem. If you have another crisis, or rather when the next crisis happens, if you have investment banks engaging in speculative activities in the same institution as commercial banks that are holding the deposits of households and companies, you will not be able to separate them. That they were separated very effectively in the United States from 1929 to 1999. I think that the current proposals are incredibly weak. The proposals that were made by the Liikanen Commission here in the Euro area were weak. And since then, there's been massive lobbying by the banks, and its proposals are only being implemented in a very moderate way. So we are moving towards a financial transactions tax, first proposed actually by Keynes in the 30s, but more recently proposed by the US economist James Tobin in the 70s. But they're leaving out foreign exchange, the single most important market that is proposed. There have been measures on short selling, which is good. There have been caps on bonuses, which are good. But given the scale of the problem, these are very minor proposals, in my view. And it's true, there has been a green paper on Eurobonds, but and many countries in the Euro area have historically been strongly in favour of Eurobonds, but as I think I was asked down here somewhere, the German government is not in favour. In fact, there was something terrible in reading the Financial Times on the way here, on the plane this morning. Some of you may have seen that Ireland has just exited from its rescue programme. And it has decided not to negotiate a new one, which would have been there as a what do you call it? That you
safety net.
A safety net, thank you, a safety net. And the answer of the Irish Prime Minister was, he'd phoned up Mrs. Merkel to ask her what she thought, and she said it was up to the Germans to do what they wanted. The Irish to do what they wanted. What's going on? When you have to phone up the German government before you decide on what your policy in Europe is. This is crazy.
Can I just say that I find the talk very interesting and the policies that you come up with very interesting. But to me, the ghost in the room that hasn't been touched on, except it was a real hot spot when you mentioned that central banks and private high street commercial banks are able to create money out of nothing, lend it into the economy at interest, that all these policies that you've mentioned seem to allow any fall out of recession to still depend on a debt-based economy. So even if the economy grows, even if it grows environmentally friendlily, whilst we have this fractional reserve banking system, we are still slaves to debt, and the problem will rise again. So I'm missing what I sense is the ghost in the room in policies that you're suggesting.
But my view is that the major problem are the giant capitalist corporations that basically drive our economy forward, and it's their decisions that determine effectively what our world is going to look like in the next 20 or 30 years.
If we stop them using borrowed money to do their fancy ethereal banking with, why not stop the banks lending money that doesn't exist? Because that would deflate the whole of the ethereal economy.
Basically, the capitalist countries broke the link between money and gold more or less in the early 30s and definitively in 1971. That seems to me to be a progressive step forward. To tie the money that you have to something you have to dig out of the earth is an unnecessary restriction.
Why not return to that and forbid the banks printing money out?
I don't believe that that's a central problem. I'm myself in favour of publicly owned and cooperative banks, but they would still, in my view, create money so long as we have a money economy. It's a system of money that offers much greater possibility of social and democratic control than any other system. We don't have that at the moment, but I believe that it is the basis for doing that. On investment, it is true that the European Commission has talked about investment, but the European Council, the heads of government, have, in the new proposed budget from 2014 to 2020, they cut the budget that was proposed by the Commission, and the cuts mainly fall on long-term investment. So that at the moment, the one crucial area that's essential is being cut back. I think Keynes's essay on his grandchildren, the economic prospects for his grandchildren, is wonderful. I too look forward to a world which is not dominated by waged work, and would have great sympathy with moving towards an economy based on cooperative structures. The environmental crisis, you're absolutely right, my presentation was extremely weak. The only place that I did touch on it was on the investment strategy, and I do see an absolutely central feature of an investment strategy as being to transform the economy in such a way that it is not dependent on renewable resources, in such a way that it does not emit large quantities of carbon dioxide. We need to massively, massively reduce our consumption of non-renewable resources. That seems to me must be a central, absolute guiding light of a European investment program. On influence, we have very little influence. We publish our report, we give lots of talks, I speak to a lot of trade union conferences, I speak at NGO conferences, that ultimately, you know, it's only when you have strong political pressure behind these ideas. What we try to do is show that there are alternatives to the current policies. But policy is not discussed by a rational argument. I remember that when the House of Commons first introduced its monetary policy committee at the beginning of the 80s, that you had a situation where the politicians were all asking what are the theories, what's the evidence, and the economists knew it was about power and who controlled resources. You can have different visions, but you know you have to have a political support.
I think we're going to have to stop.
Yeah.
Friends, remember you've got the rest of the weekend to discuss all these things. You don't have to do it all this evening. Sasha, are there any housekeeping announcements? They are programmed for now. Right, Imogen, do you need a microphone?
Yeah, that would be a good idea.